Hey everybody, welcome back. Well, S&P makes another all-time high. This one was pretty interesting because the PPI was decent. But if you can take a look right here, we didn't really go anywhere. We formed a doji. Dojis are signs of uncertainty, candidly, and the breadth wasn't that great today. The most important thing is what names moved, what names didn't. Now, for me, the way that we're sitting up here, it kind of gave me a little bit of concern if we take a look at the NQ, which we will in a moment. But let's just spend a moment and look at this on a 5-minute chart. And you can see how we extend all the way back here from the 6 p.m. level. But watch, there's a couple really specific periods in time. Now, if you've been watching these videos for a while, you know what levels I'm about to point out. But this was the news at 8:30, and this was the movement. So you always want to mark off those 8:30 bars, and you want to watch how you act at them. I tend to mark them off on a 1 minute. In this case, it was pretty much the same thing. It's not always that case. What you can see from that 1 minute up, straight across, from when you open, that was it. 9:30, boom. We never got above that bar. Once you broke there, and you can see this retest really carefully in here, and I'm showing you this for a reason, because what it does is it allows you to understand, and you can use this, especially if you're traded zero-dated options, how most of you crazy kids like to do. See how you came down and then you retested and then you broke? Those retests pretty much tell you everything you need to know. And they give you a really good spot if you want to put on some zero-dated option puts. Again, you just mark those off. It was really good data, and they shrugged it off, and then basically by the end of the day, you just went sideways, and this is what we wound up with. Now, I think that this is really important for you to get. We had trouble holding the low on the ES. Now, if we take a moment and we go take a look at the NQ, we pop the NQ in, slide that back. Now, this level that you have marked is from a different day. Now, you'll remember why we have that marked if you watched yesterday's video, but you can see it right here as well, but you'll remember why that's marked the way that it is. Now, one of the things that I think is really important is you're always looking for differentiations. And what we're going to do is clean that line off for a second. And we're just going to go right here and look at that 8:30 mark and take a look and see what happened there. And what do you say? You see that 8:30 mark, you see the retest of that 8:30 mark around 11:44, and then what happens? We fall down, and then we can't what? Get back above it. But you note something here that you probably already noticed on the other one. Look what happened at 1 o'clock. And then I like to say, well, what happened at 1 o'clock that created this, that made us go straight up for the rest of the day? We'll get into that in a second. What did we see more than anything today was just outright buys on some of these names, like AVGO, splitting 10 for 1. And then you had this really good earnings. I mean, just solid earnings. But what AVGO did was a couple things. It showed you that there were 4 or 5 names that probably are beaten down that shouldn't be, and we're going to get to those names. But I want to just point out this first. Let's go here. If you look at the 10-year, we're going to get rid of this. The 10-year is absolutely being bought. Okay, so that is telling you that where they think rates are going. Rates are probably not going to be cut until September, if they're going to be cut at all, in my opinion. If you take a look, I don't think it's going to matter for the market. I'm going to explain why. They're going to buy bonds anyway, and you can see them doing it. They don't care. They're going to buy bonds anyway. Why are they going to buy bonds? Because they know now that they're not going to raise rates. That was very clear yesterday. It was the one thing that people really missed on that call. They're not going to raise rates. It is very clear that no matter what they see happening, that is the last thing on their mind. It was floating out there. You no longer see it in the CME Fed tool. And since his talk, all they've done is buy bonds. Even though the probability of a rate cut dropped in September, which we're going to get to, it dropped. Even with that going on, they're buying bonds. So if we went and looked at here on an hourly, you can see it as well. It's just straight bond buying. So usually this runs in tandem. So in other words, let's say that you're going to put yourself in a position and they're not going to cut rate. You would see the bond market actually sell off if there was less probability. In this case, all you did was round off at 2:30. Once he started speaking, that became abundantly clear. If you look at this time, we draw this out even a little clearer. You can watch this play out on the day, right? On Monday, all the way to here. And you can just kind of start seeing how this stuff plays out, right? It's really important, again, to just understand this stuff, because when you do, you can make more informed decisions. And you just see how it just fell off a cliff, right? This was all them saying, you know what? Yeah, you're definitely not going to raise rates, but what are you going to do? Eventually, you're going to cut, and we want to start locking some money in now. So they're buying this. And this is good for us with equity risk premium. And we're going to get to that as well. So that's why this is happening, and that's why the market's moving higher. Now, for me and the AVGO trade, I marked off a level before that we're going to get into. It's really important to watch that level. But you saw these names like breaking out today, like why did a net rally today? Why did SMCI explode? Got 100 different levels on here I can clean off. Why did SMCI explode? Why did Dell rally? And I mean, look at NVIDIA once again. And this is really impressive to me because this is not what I expected, but you closed at the high. You actually have a dragonfly at the top of the chart. Probably something not that you want to bet against. We're going to get into this, but I think it's really important to understand why they're buying the 10-year and why that's really good for us that are trading tech stocks. PPI is what corporations pay. CPI is what we pay. Really important to get that. They're not going to do us any favors, right? We know that. So what this always means is we want to see what they're paying because that tells us what we're going to pay. Think about this as the future CPI to an extent. Now, if we look here, we're going to get the forecast, we're going to get the consensus, the previous, and the actual. And this is really just from Trading Economics. Anybody can go there at any time and pull it up themselves. But what we're going to focus on is what actually happened. Do you have right here the actual, which was negative, which means a decrease. Now this is pretty rare. I'm going to show you how rare in a second. But you then also had the consensus here. So you beat by a lot. You were supposed to come in month over month, 0.1. You came in at negative 0.2, 0.3%, and then you came in at 0. So when you see this, it becomes a real issue. Now, the other side of this is also initial jobless claims. 242 is a big number. Anything over 250 starts getting people's attention. But 242 is a big number, so it's definitely worth paying attention to. From our perspective, when we started looking here at 18 and then 18.2, continuing claims, yes, it's an issue, it's higher. But when you start jumping like this becomes a much bigger issue. We started at 200, now you're up to 242. Now we were looking for 225. It's been creeping up. Core PPI month over month, lower, negative month over month. All this data confirms what we know. Things are starting to get worse, meaning pricing pressure is it's actually eating up. And basically that just means that things should over time get cheaper. Now, year over year core PPI, you're at 2.4 versus 2.3. That's important to pay attention to. But I always look at this too, and I think people miss this. So this is the total amount. They do a total absolute amount. And it was lower. So that means we are going in the right direction. And they break this down line by line, X food, energy, and trade. I mean, why even have it, right? And then PPI year over year, it was supposed to be 2.5, where to come in. Again, when we start to look at this stuff and you start to outline that they're putting everything, like every single thing is in month over month PPI, right? And then core PPI month over month, they take out food and energy. And that was 0 versus 0.3. And then on top of that, the years are down right here. And that's important. So it's all correlating together. And this is exactly what you want to see. Then as the day unraveled, you want to see how people act on that data. Well, there's no better way to see what people are actually think is going to happen than watch where they put their money. And what did they do? They bought the 4-week T-bill auction. They bought the 8-week T-bill auction. And I'll show you in a moment how you can see them actually do this and you can watch how it acts to the market. 463 was the previous 30-year bond auction. Now you're at 440. This is really important, guys, because when you understand this stuff, it can make all the difference. But this PPI month over month number, take a look at this. Now this number, I'm going to give you a 5 years right here. And this is month over 5 years. And this is just CPI month over month. This was negative, but what I want to show you by just drawing this across is that if you go back to the pandemic, you really do not have a lot of these. Not really at all. And if you really think about it, you've only had 1, 2, 3, 4 worse readings for PPI month over month since this all began. And that's really important because we started to see these spikes, right? And those spikes became a real issue. Now we did spend some time already on the Fed and the FOMC. But Goldman put out this sheet, and I think it'd be really helpful for you to understand exactly how this went yesterday with the rate cuts and why it was so important and what we saw. So this is just a piece of research that they put out. And what it is how did the market view the probability of a rate cut by September at various points in yesterday? And when that CPI came out yesterday that we went over that was very bullish for the equity markets, at 8:30, the probability of a rate cut by September spiked all the way to that 85. They'll take one cut plus if there's a probability of 2 cuts. And you can always look at this yourself through CME Fed Tool. But what they did a great job of, and which I'm not going to do, is they broke it down line by line. So as soon as the FOMC statement was released, that's right here. Once that statement was released, you can see what happens. We start to plummet down. And once that plummeting starts, I'll just do that in blue so you can see that. Once that plummeting starts, we're like, okay, Well, it's not that bad. And then Ichi starts speaking and then just kept getting worse and worse and worse as time goes on. Why is this important? It's important because what he's saying is conveying they do not see a reason to raise or cut rates. Apologies. So how does this help us? I think that we have to understand that they are in no hurry, despite what the equity markets want, despite what the equity markets think. And I would suggest that looking at this and the fact that you had 7 members come out and say only 1, and then other members say 2, our best case scenario, and this is where Goldman went, JP Morgan and Morgan Stanley, they all went to September. And then they go September and then another one in December. I think that's being optimistic right now, but we're going to have to see how this data comes out. Now, on Saturday's video, make sure that you watch because I'm going to go through the next events that we're going to have to watch. For those that are new at these videos, what we do is we give a synopsis on the day, every day of the week, and then we roll it in Saturdays, and Saturdays are a long form video that carries us through the week. So you're going to want to watch Saturday's video so that you can prep. Now in front of you is a chart, and those that have been watching these videos for some time will be aware of this, but I think it's important for us to just kind of go over this again for those that are newer. And the most important part of this chart for me is just understanding the nuances. So in front of you is just the 10-year, and this is the yield on the 10-year. And what we like to do is we like to look at key events. So down here, you'll see 11:30, and then you'll see 1 o'clock right here. Now, at 11:30, you had the short-term bond auction, and then at 1 o'clock, you had the long-term 30-year bond auction. And what we're always looking for is not what they say, but what they do. So if you look at the 10-year, which is the TNX right here, or you look at the SPY right here and the dollar right here, they all move in tandem. And what we're going to see is at 11:30, we had a decent move. Now, what struck that move at 11:30 was that they went out there and they bought. So if we just look here, what happened? Okay, well, yield was bought. So as they bought yield, meaning they bought bonds, because it was a good auction, that dropped. Equities went higher and the dollar dropped. That's usually what happens. Then you come here and look at 1 o'clock. The longer dated bond will always have a stronger move than the shorter dated. It's just the way that it is. Unless something really wonky happens, but on average, you want to watch the longer dated bond. Now, if you were going here and you were looking at the longer dated bond, you can see that you just basically fell off a cliff right in here, right? And then what happened to the S&P since that time? Well, the S&P's done nothing but go straight up. Now, as that's going up, we're going to get more into it, but you see the dollar actually dropping too. But this is why understanding what we just went over, even if people are like, I don't care about macro, I'm a day trader. A lot of people that have been watching these videos, when they start connecting these dots, start to see it. But as I always say, I look at it as a stool, right? So we have basically the macro, then you have the fundamental, and then you have the technical side of the market, and then this is where we sit. Now, that's the market in and of itself. And so you have a macro leg, a fundamental leg, and a technical leg. And this basically just tells you what on the macro side, then the who, and then the when, okay? And if you think about it that way, every investment bank is set up that way. Every investment bank has an economist, every investment bank has a research house, and every investment bank has a technician. So why shouldn't you be set up the same way? Why this is important, you're like, I'm a day trader, I don't care. Let's take a look at why this is important. Now, for our purposes, I took a bunch of random names, and I'll show you them. And then you can do this test yourself. And does it work for all of them? No, because you know what? Not everything always works. But here's ARM, here's NVIDIA, ELF, Apple, here's the SPY, and here's Costco. And what I did was I even tried to pick some names that were actually under, but it doesn't matter. I just grabbed a bunch of random names, and you can do it too. Now you're going to note that 1 o'clock right here. And let's do it this way, because if we just drop this down, it'll be even easier to see. There's the 1 p.m. level. And if we look at that level straight across right here, should be able to drop that in, and you will see that from that 1 on, I actually raised that up a little bit more, it should actually be down about here. You'll see that they're all up. Everything from 1 o'clock is up. Okay, so the other demarcation thing you can always do if you're looking for ideas is you want them to be above the SPY usually. But what is this telling you? Well, this is telling you pretty clear that you've had nothing but equity buyers since the bond market auction at 1 o'clock. This allows you to make more informed decisions. It's one more piece of data. And candidly, it's one piece of data that we don't see a lot of people using. So there's significant edge to it. Now, most people will say, why do I care what the bond market's doing and why does the bond market move that way? There's a really interesting calculation that I will review with you sometimes called equity risk premium. And the whole purpose of the review of this is to understand what's really moving the market. And we're going to talk about what it is, but what we're always looking for is we're always looking for this to get more attractive, not less attractive. So let's take a moment, let's review what it is, and let's talk about what's going on. Now, the definition, first and foremost, this should be used long term. You're going to see those micro moves like we just talked about, but you're really looking at this for the long term. You're not really looking at this for anything you're not really looking at this for anything really short term. So you're looking intraday to see what they're doing for your movements, but long term is really the way to look at this. To get the most value out of it. But let's get into it. This shows earnings yield. This shows earnings yield on the S&P minus the interest rate on the 10-year notes. The higher the risk premium, the more attractive stocks are relative to bonds. So note this says earnings yield, not dividend yield. So earnings yield is take the price of the S&P, take all the earnings, divide it, you're going to get a yield. All right. And we've walked through that before. And then what you're doing is you're subtracting that by the 10-year. The higher the risk premium, the more attractive stocks are relative to bonds. This is why it's so important for us to know what the Fed's doing, because when the Fed moves, that is going to affect us. It's going to affect us greatly. And so we always just want to be aware of that, right? What is the Fed doing? Why? Equity risk premium. Who's doing this on a longer term time frame? It's not us, it's institutions. Now, there are two ways that this could move, in our favor. Number one, earnings yield could go up. So if earnings yield goes up, right, then what's going to happen? Then we're going to see that the price is going to go higher based upon that, all right? So in other words, if earnings yield goes higher, how do you get a higher earnings yield? You're going to get a higher earnings yield two ways. The first way to get a higher earnings yield is this. Earnings go higher. The second way to get a higher earnings yield is for the market to drop, and then the earnings yield goes higher. Okay, so they're really the only ways that you're going to get it. Either the price is going to drop and the earnings yield is going to go up because of that, or earnings are going to go up and that's going to drive the price up as well. That's really how you're going to get it, one of those two ways. Most of the time, it's just the earnings go up. It's very rare that the market's going to plummet all the time consistently for days and days and earnings are going to go higher. It just really doesn't work that way. We all know that to some extent. It could have those little nuances where you have an up and down moment, but that's really it. So what happened and why are we taking a look at this on a yearly? Real simple. It's very, very simple. Why? If we take a look back in November, what happened in here was the Fed said we're going to stop cutting rates, or we're going to stop raising rates. Apologies. So what happened all in here? Equity risk premium went higher and higher. And then what happened all this time? Equity risk went higher and higher. And then you would go, well, when did it stop? Well, it stopped right here, right around that January timeframe. And then you start that decline. And then what happens after that decline? We find a medium, didn't you? And you're actually going higher now, but you found the medium kind of area. And once you found that medium, what happened? The market stopped. So that let you know that that's the area where they're most comfortable to buy. Like that's pretty much it, right? From an equity risk premium standpoint, this is one data point, but it's a very significant data point because it's used not only by people that are trading, but institutions will look at this and go, well, what's the equity risk premium of the market right now? Okay, allocate to the S&P, allocate to the 10-year, allocate to the 2-year. This is how pension funds look at their portfolio, because this is how they can do their assumptions, which is a different conversation, but this is how they invest. So for us, we always want to look at this and we want to see what they're doing. Now we're seeing that rise, and that was the greatest time to make money, right? Like it was really easy off that bounce to make money versus this time when you're coming down. What happened here? We dropped and then we found the base, and then from that base, we started to what? Actually go higher. Let's drill into this. Now, on a smaller intraday level, this is why you care. On a more swing trade level, this is why you care. Look at this peak right here. And then if you look at that level from here and you look at this down, what do you have? Well, you have the low of the equity risk premium. And then what happened as we start to go higher? It's not rocket science as to what's happening here, right? And we can all see exactly how this is playing out. But if you take a look at this, you're starting to just kind of go a little bit higher over time, aren't you? And what's happening to the market since then? You're going higher. This is why you care about the bond market. This is why you care about economic data. This is why you want a three-legged stool. This is why you want to focus on the macro, the fundamentals, and the technicals, because this is what your key driver is, because institutions are looking at it. Now let's watch this turn on a 3-month. Now, as always, your comments are greatly appreciated. And the reason I'm spending time walking through this is because of your comments. And I find it most helpful that when I show an indicator that you not only understand how it's calculated so that you understand why it may move, but also you can see how it's playing out in real time. If you look at even MACD or anything else that we have out there, MACD, RSI, any of these things, they're all kicking in like around here, right? If you go and look at them, the MACD, the RSI, all these macro stuff, all the macro stuff's telling you ahead of where the technical stuff's going to be, right? It just doesn't, we just don't know the magnitude of what it's going to be. But if we look here versus these levels, it was pretty clear what was going on. And we can see this over a 3-month period, and you can see how we're going straight what? Up. Now that's important to me, because this is in tandem. So as we're watching this play out, We always want to watch that. We always want to make sure that things are congruent. So yep, we are going higher here on the S&P, and at the same time, we're watching the equity risk premium go up as well. Please comment on this. It's really important to me to understand what you guys want to see. I don't really want to spend time showing you what I think is actionable if you don't find value in it, but I find it very helpful to understand why things are moving the way that they are. Now, there's a few names I want to go over specifically because of what happened yesterday with the AVGO, but I think there's a couple names that we want to cover before then. Tesla, obviously you can see what happened here. He got his pay package. It's highly dilutive to shareholders. People were all excited and giddy when he finally got it and that they were able to move, and he thanked everybody. I guess they're going to have their meeting. But essentially, you got right to this breakdown bar right here, that little control bar, which you've been unable to get above. And guess what happened? You broke again. What happens here? Well, the good news is out. So I think you might retrace back to that 173 level. Only time's going to tell. But I would have this on my radar tomorrow for sure. It's definitely one that I'd be paying attention to. Other than that, what else out there really drove the market that didn't have to do with AVGO? Very little today. I mean, you saw some of these other names move, like the Lillies of the world, and they broke out again, and they're pushing. This is somewhat interesting how you have all these wicks up here, and then you just reversed. But there's not really much more to say. You had a day where the bottom kind of fell out because it just is that kind of day, especially when you're gapping up like. But what we're seeing here is that AVGO, you kind of held. And by kind of, I mean, I was expecting something like this because these are the kinds of moves you see where you're just straight down, and you didn't get that today. So I thought that was a nice differential that we just didn't have to deal with that kind of stuff today, where you're just, just dropping straight down. It's very rare do you do this where you're just lifting on earnings. It's more, you come out with earnings and then you're gapping down like here. And last one was just a dumpster fire, on the gross margin side. This one we did really well with, and I'm very happy the way that it acted. There's very little to say about it, so it was good. And that's exactly what we want to see. That said, watch this on a 5-minute chart, because this was kind of funny. Everything was in that 5-minute bar. I mean, you didn't have really more than 1 or 2 closes outside that 5 minutes. And you had like a test right in here, and then it was just riding the low of whoever's down there buying. And you're hoping that you don't gap fill is what they're doing here. But what this did do was it solidified margins, and it also solidified software. And this was something that 3 specific companies, in my opinion, really took it on the chin. But the first and foremost, usually this is when NVIDIA comes out and NVIDIA falls. If you go look at when AMD comes out, I went over this Saturday and went over it again. That's not what happened. NVIDIA formed basically a dragonfly at the top of a pattern. You really don't want to play with these. So from a short-term technical standpoint, remember, wicks are price rejection. And what did you get today? You got a complete rejection of selling in here, which is absolutely fascinating to me, but nonetheless, it happened. And then what wound up happening is we flipped and we're pushing. And this is a huge distinction from the way that this usually plays out. And yes, was it light volume? Yes, it was. Everyone's going to point at the volume, and I get that. And it was light volume. But nonetheless, this is where you're at. Nobody's selling. I would watch this tomorrow. I thought this was really impressive the way that it held. So what were the benefits of AVGO? I think there were 3 specific names that benefited greatly. If you look at Arete had some issues. You saw the earnings here. And then when we started to drop, like on May 23rd, well, I mean, if you start looking at names like Dell, for example, when did Dell fall out? Right around May 30th. Again, you start seeing these moves. How about SMCI? Same thing, right? On earnings, what did it do? Drop down, never really able to rally. What AVGO did was show that the margins are there and the need for the software is there, and that propelled these 3 names higher. Now, I would suggest that you just watch how they act tomorrow. There's 2 more we should probably go over, but that had earnings tonight. But if you take a look at this and you look at Arete, that's chart setting up. If you look at something like SMCI, this is a little more aggressive, but you did close above the 55, and I do think that that's worth paying attention to. Now, you did here as well. I think it's a little bit worth your time to watch this on a volume spike like that, because I think that this was kind of counted out on the margin side. I was really concerned about AVGO going in the margins, and even Dell had some volume today and held. So I think those 3 names benefited greatly from AVGO, and we'll see how that goes. NVIDIA certainly did benefit from that. But again, that's a really powerful move on very light volume. But we'll see how it plays out. You have earnings, you have expiration of options tomorrow. 2 names that came out tonight. One, you have the Adobe. Now, this was a really good report, solid report, nowhere near as bad as people thought it was going to be, and you're already into this gap. Just technically speaking, I mean, you're really looking right up here. Can this push? Yeah, this could really push. and you're seeing nothing but straight up buying after hours. And let's get to it right here. It was a really good report, and I was very surprised by how good it was. Just disclosure at the time of this, I do have a position on, and you're watching this go up. And I have one more, like, I guess we'll call it a bonus thing to look at. But I do like this. Also, RH is down after hours. The report, it's not great. They missed on the earnings side because they're going to take a write-off over something. I did not view this as down 15%. Now, Restoration Hardware has a history of doing this, where they gap you down and then it will lift either 1 or 2 days later, or sometimes it's not going to do that. But I wouldn't sleep on this. I wouldn't just assume that this is going to stay down the market. This is definitely one that I would be paying attention to, that's for sure. And I just want to point one more thing out here while I'm thinking about it. With GME, a lot of people that trade GME, what I want to just point out about this is, if someone shows you that they have a huge, massive position, for example, the Roaring Kitty guy was showing everybody how big his call position was, you have the ability to go to open interest, which is updated real time, and you can look at the open interest and see whether or not that position is still open. And that might be something you want to do in the future. If, let's say, someone does a YouTube podcast or whatever you want to call that, and then you go look at the open position and it just happens to not even be as big as his open interest, that might be something you want to pay attention to. That's it.